Good day and welcome to Data Patterns India Limited Q4 FY2023 earnings conference call hosted by Go India Advisors. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Samadrita from Go India Advisors. Thank you, and over to you, ma'am.
Thank you, Aman. Good morning, everyone, and welcome to Data Patterns India Limited earnings call to discuss Q4 and FY23 results. We have on the call with us Mr. Rangarajan, Chairman and Managing Director, Ms. Rekha Murthy Rangarajan, Whole-Time Director, Mr. Venkat Subramanian, Chief Financial Officer. I must remind you that the discussion on today's call may include certain forward-looking statements and must be therefore viewed in conjunction with the risk that company may face. A small request to the participants, please restrict your questions to one or two, as Mr. Rangarajan is taking the call from abroad, and given his other business commitments, we have to restrict this call to strictly an hour. I will now hand over to Mr. Rangarajan. Over to you, sir.
Good morning, ladies and gentlemen. Thank you for joining us today for the FY23 results call. I assume you've had the chance to review the results presentation, which is made available on the exchanges and our website. Before Venkat proceeds with the financial results, I'd like to provide a brief overview of some strategic updates and key highlights for this year. It gives me great pleasure to share that the company has exceeded its initial 25 to 30% revenue growth guidance, achieving a 46% growth for the year. PAT for the year had a growth of 32% year-on-year. As explained in the press release, my focus in the last few years has been to smoothen the revenue profile over the quarters rather than rely on the big four quarters. Q4 as a percentage of annual revenue has come down from 70% in FY21 to 41% in FY23. Predicting quarterly revenue and gross margins are becoming very challenging due to customer inspection timelines and product mix issues. Therefore, I would like you all to assess the progress of the company on an annual basis. Gross margin of Data Patterns' own products will continue to be robust in the region of 65%. This overall gross margins may be lower when I'm integrating borrowed items, but this will drive more growth in revenue. Considering the volatility in top line and the growth due to these factors, the right metric to evaluate the company is PAT growth. I'm confident that we will continue to grow PAT at 30% in years. As you know, we are in an investment phase to continue to invest in people, technology, and infrastructure. I don't want to calibrate the quarterly results. Hold me accountable on an annual basis on the key metrics. Having said that, to give you some visibility on FY24, we expect the EBITDA margin to be around 40%. FY23 has been a momentous year for the company on the order booking front, with order inflows for the year crossing 900 crore mark, up more than 3x from the last year. As of March 31, 2023, the order book stood at 924 crore, up almost 2x compared to the last year. The inclusion of these orders finalized in April and May so far, our current order book is in excess of 1,000 crores. In FY23, we secured several significant contracts, including radar orders valued at 449 crores from DRDO, Bharat Electronics, and Department of Space, encompassing both development and production. Electronic warfare development order worth 23 crores from DRDO. Production orders for BrahMos for rupees 40 crores. I anticipate a significant order booking in FY24, and most of that will be from Data Patterns' own products to single vendor tenders. CFO will give you some color on working capital movements, particularly after the March closing. Even based on our reported March 31st financials, the cash conversion cycle, net of advances, has improved during FY23 to 275 days from 286 days at the end of FY22. The whole management team is very focused on the key metric and committed to continuously improving it. Needless to say, maintaining robust ROCE and ROE metrics will be our focus. Even for FY23, excluding the impact of QIP funds received in March, the company's ROC has remained strong at 22%. We expect our sustainable return metrics to be above 20% as we complete the product development investments. As you know, we raised equity through QIP to take advantage of the significant opportunities presented to us. I'm thankful that investors have entrusted me with 500 crore. The management team is fully focused on building next generation products that will help scale the company in a big way. The proceeds for this new investment will be utilized for the development of new products in the areas of radars, electronic warfare, communications, and satellites. Initially, these products will be introduced in the domestic market and will subsequently be expanded to export markets. We anticipate these products to be a significant growth driver in the company over the next 3 to 5 years. I will be sharing more details on the progress over time. At this point, I'll pass the floor to Venkat for his comments.
Thank you, sir. Good morning, ladies and gentlemen. We are delighted to report an outstanding performance in FY23. Let me provide an overview of FY23 financial results. FY23 revenues witnessed a year-on-year increase of 46%. Development contracts accounted for 41% of Q4 FY23 revenue compared to 37% in Q4 of FY22. Production contracts made up approximately 57% and service contracts approximately 2% of Q4 FY23 revenue. Gross margins for FY23 were at 62%. PAT for the year increased by 32% to reach 124 crore, driven by a strong growth in revenue. The commissioning of our new infrastructure took place in Q4 FY23. We have invested around 45 crore in this new facility. Despite an increase in debtor days, the overall working capital cycle due to substantial advance from the ongoing projects. Even on the receivables front, April collections have significantly improved the cycle, which tends to be higher at the year end. Around 25% of year-end receivables have already been collected. Receivable days stands at 241 after accounting for funds collected in April and May. Notably, a large portion of the receivables as at March end, more than 100 crore, is attributable to the Precision Approach Radar project, of which a significant amount has already been collected in April. As of March 31, 2023, the company holds over 650 crore in cash and cash equivalents. We aim to maintain a robust balance sheet going forward as well without any net debt and aim to gradually improve our working capital days. Overall, FY23 demonstrated impressive performance, achieving record revenue, strong profitability and robust balance sheet. We will now proceed with the question and answer session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to limit their question to 2 per participant. If time permits, you may join the queue for any follow-ups. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question may press star and 1. The first question is from the line of Jehan Bada from Nirmal Bang. Please go ahead.
Good morning, sir. Sir, I have 2 questions. First one is on the raw material side. Quarter 4 raw material cost to sales has been high. So what was exactly the reason? And for FY24, should we look at the 9 month as an indicator or quarter
4? See, as I've always been mentioning, the raw material cost to sale price varies with project to project and product to product. So that is why we have told this cost, 38% material cost on sales. This will vary from contract to contract. However, we give a guidance that typically we do about 60% of gross margin on an overall project. And these are all based on the products developed by us or data patterns products. If we have to buy and integrate, then obviously the raw material cost becomes as a percentage more in the selling price. But I think we can take a guidance of 68%, around 60% on an overall year rather than quarter to quarter, because what we deliver each quarter varies with the kind of products.
Right. Fine, sir. Okay. And sir, second question, if I look at the presentation, the order book mix has shifted in favor of development contracts from last year 25%. This year it is at 64% mix. So will that impact the margins going forward?
Okay, see, margins are not really determined by development or production. Margins, it depends on kind of development contracts you get. If it is more on data patterns products without integration, then the margin remains the same. And in case integration happens, then the margin comes down. So it really doesn't do anything with development or production. What really happens in development is there's an overhead in terms of development cost and development expenses they incur over on top of the component cost or material cost. In production, since it's a repeat of the earlier delivered production developed contracts, our overhead allocation in terms of product manufacturing is going to be only there, and not development cost is not there, as we tend to write off the development cost as part of revenue expenses of that year. So that is typically what happens. Okay. Now, giving you more clarity is, see, we are a very engineering-driven company. We are more than 500 engineers working with us. We tend to build that engineering capability, build more products. So one way of looking at it is more development contracts. It also gives me a future production contract possibility, which will scale the business. So a healthy mix of development and production is good. Last year, we got a lot of tender contracts on DRDO, and development contracts have come. These are all very strategic contracts. We expect that these contracts will scale the business going along.
Thank you. Mr. Bada, requested to join the queue for any follow-ups. The next question is from the line of Akshay Kothari from Envision Capital. Please go ahead.
Yeah, thanks for the opportunity and congratulations on a good top line growth, sir. So just wanted to know, you have mentioned that you are going to increase the headcount of engineers by 100 more. So how do we plan to maintain that 40% EBITDA margin range? Because we missed it this time as well. So
we're looking at multiple times scaling the company because the market size is very large. So in order to scale the company, you must build products to scale. Because you cannot say, I will have few products, and that will, this is not a business model where same product gets procured multiple times. There are many programs and projects. We need to address the products. India is traditionally used to importing major part of our defense equipment is imported. Our idea is to try to build those products which are being imported. See that this can be ordered in India. And if you do that with Indian technology, then the EBITDA and the gross margins and the bottom lines, what we're looking at, will maintain. So, increasing headcount per se, if you say increase headcount and the revenue becomes same, then the EBITDA goes down. But the revenue also goes up. I don't think we'll have a problem. Matter of fact, this is a very important thing that we increase capability and competence to build more products to scale our revenue. And anyway, we're giving a guidance that this will be around 40% this year, based on contracts and what we expect to deliver this year.
thanks a lot. And all this.
Thank you. Any participants would like to ask a question at this time, they may please press star and 1. The next question is from the line of Aditya Makharia from HDFC Securities. Please go ahead.
Yes, sir. Hi. Just wanted a sense on the competitive landscape. So is there any way you can define your market share, or maybe, if not exact numbers, what's your share of business, for the particular...
Sorry, Aditya, your voice is breaking. Can I request you to come in network? Or use the...
Yeah, hi. Is it better now?
Much better.
Yeah. So I wanted sense of market share which you have in the business you operate. You may exact numbers, but just direct.
Sorry, Aditya, again your voice is breaking. I'm sorry, request you to come in the network area, please.
Anyway, I understood Aditya's question. Let me ask on competitive landscape and market share. See, the size of business is very, very large, and the business we are addressing is much, much smaller, giving enormous scope for growth. Having said that, you can look at competitive landscape, and the entire products are actually imported. Very few things are being done here. On the product end, the landscape, the competitive landscape is only foreigners. We are trying to address that market and try to enhance our products into this. But if you look at what we deliver on an Indian context, with Indian competition, we are very well placed in the areas of radars, in the areas of electronic warfare, and so these are areas where the company has deep competency. So on a technical competency, it's far, far higher than others. But we can't talk about market share per se because that varies contract to contract, it varies and depending on individual capabilities. A lot of people tie up with foreign companies and they make the product available here. We typically tend to develop products here, and that is why the EBITDA or the gross margins are higher. So the idea is to try to enhance our market by building more products, is what we are trying to do. And these products we develop on the development contracts, they will repeat business to scale the business. But we also done QIP, 500 crore money we got in. We're essentially going to be into product development in the various areas where we'll try to bring in leadership in this area, which can scale the company multifold.
Okay, got it. Thank you.
Okay. Yeah.
Thank you. The next question is from the line of Jonas Bhutta from Birla Mutual Fund. Please go ahead.
Hi, Ranga sir. How are you?
I'm fine. Jonas.
Hi. So just two quick questions. Firstly, can you talk about the two orders that we got from DRDO worth about 130 odd crores? One, the radar, the 83 crores, and the EW 53 crores. What are the projects and whether we are the lead here or we are supposed to, after this development project, this will ultimately go to one of the PSUs where we'll again be a subcomponent supplier. If you can talk about that first.
Your voice is not very clear, but I'm assuming this is a question. You want us to talk about two orders from DRDO, one on radar, other on EW. Am I correct?
Yes, sir. The 83 and the 53 crores. Yeah.
Okay. See, this is a couple of contracts we received from DRDO. This is for requirement for upgradation of radars and electronic warfare system for a naval application. We expect to deliver this contract by this year, and requirements are more than 20 to 30 aircrafts to be upgraded. If this is successful, then we should place an order on HAL for further upgrade. So this is an important order for us. It will give us revenue visibility in the next 2 to 3 years.
Understood.
And already we are on the job, so we should be able to finish the contract on time. And it will be equal to any international product in this range.
Got it. And so sorry, I missed out in the opening remarks a bit. So did you give a guidance on what kind of order inflows you expect for FY24? Because I assume that the Himshakti order and a couple of Rudra orders should sort of flow in. So what are the total orders that you're expecting for F24?
I didn't mention a particular number, except that we expect sizable order inflows this year. This because we don't want to talk about the specific contract. You are aware of Himshakti and all the orders which we talked last year. Bharat Electronics will receive the orders. Back to back, the inquiries have to flow in, and we should be able to get those contracts. But we expect the order book to be sizable like last year. This year also, we expect that maybe more than 680 crores contracts. We're not very sure exactly what time those contracts will come. But one difference between last year and this year is we expect a number of data products orders to come in. As against integration contracts we've taken up last year, this will also have mostly data products. On top of it, we're also participating in tenders, and if we are successful, hopefully we'll have a repeat year like last year on terms of contracts. But I think it's upwards of 657 crores of data products.
Understood. Sen, the last question was around net working capital. If Venkat can give us the latest numbers on the margin money, because I think about 116 or 120 odd crores was sitting as part of other current assets last year. What is the number for the current year as in FY23? What is the number on the margin money? And we see that the advances have gone up as we've received orders. So what is the rupees crore value of advances sitting in our balance sheet today?
The margin money as on date with the banks is around 80 odd crore in March. This is actually basically for the bank guarantee limits that we enjoy and a couple of LCs that we had to open. And this is expected to come down a bit because some of the margin money kept in March is with 100% cash margin. Some of the guarantees have been taken with 100% cash margin. Those will get accommodated in the enhanced limits that we have already requested, and it's in the process. Once that is done, then 100% will be removed and only the margin requirement per bank will be there. And as regards to advance, we have more than about 170 crore of advance sitting in the balance sheet, which includes advance received from a couple of development contracts in the last year.
Understood. And what is the value of unexecuted order book of these developmental projects that we won last year, about 400 odd crores that we won in the two radar projects? So, what is the unexecuted part?
What is it? Your voice is breaking.
What is the unexecuted part of the two developmental projects that we won earlier this year, the DRDO radar orders?
The two DRDO radar orders have not been delivered at all. It is for FY25 only.
Thank you. Mr. Buttar, I request you to join the queue for any follow-ups. Thank you. The next question is from the line of Dipen Vakil from InCred Equities. Please go ahead.
Thank you for the opportunity, sir. I just wanted to understand a little bit more on the order book side. So can you help me with the execution schedule as to how we plan to execute on the almost 1,000 crore orders that we 1,000 crore orders that we have currently? So will it be executed in 1.5 year or 2 years? As to how do we factor in?
I think about 50% of the orders on hand will get executed this year, this 23-24, FY24. The other 50% will get executed next year, barring another 30-40 crores. Most of it will get executed in FY25.
Okay, that's helpful. And competitive scenario going ahead as to what major orders can we expect in FY24 for us to win?
Yeah, we are expecting a sizable order intake in FY24 due to number of contracts we earlier delivered products. Those have all back-to-back contracts have happened with the public sector, BEL and HAL. So we back-to-back expect those contracts to happen. Probably in the next 2-3 quarters, we expect the contracts to come in. And most of them will get executed next year or the year after next. But a little portion of the contracts we're getting may be executed this year itself. But we do expect a sizable order intake this year.
Okay, that was all my question. Thank you so much, sir.
Thank you.
Thank you. The next question is from the line of Aman Vij from Astute Investment Management. Please go ahead.
Yeah, good morning, sir. My first question is on, so we had bid for a radar for active protection system few months back. So if you can talk about what is the addressable market size of that product, and also when is the results expected of the tender?
No, I'm not getting. Which is the active protection system you're talking about? That will be
Radar for active protection system for MBTs.
What? NBT.
For the tanks, tanks, MBTs and all those.
No, that we have not got any order for radar for active protection system or NBT. We've got an automatic weapon loader. That is a contract we got, which will get executed next year. I'm not really aware of how the contract will get into numbers as we go along. We don't have clear idea of predicting every development order, where it will go into production and when it will happen. So that is why we don't project all this properly. And we project or take projections only of contracts which will be exceedingly clear that this is going to happen, give or take a few months or a year or so. But this is in development stage. We just received the order in this last quarter. So that is not a radar actually. It's more an electromechanical system and electronic system.
Yeah. Sorry. The question was, sir, we had bid for that program, right? The development for radar of active protection system. So is the tender out and we have not won, or the tender is not out?
We keep quoting many tenders. Mm-hmm. That's why tender business we don't project at all to market, because there's a 0-1 possibility. It's either a win or a loss. So we never talk, when we talk about the next year projection or order intake, I never talk about tenders. Tenders, if it happens, it's plus. Otherwise, we don't really worry about it. More worried about our own products. And all of this is not the predictable radar. We really cannot predict the development time frame and the repeat requirements. But those kind of contracts are not very predictable.
Thank you. Mr. Vish, request to join the queue for any follow-up. Before we take the next question, I'd like to remind the participants to limit their question to 2 per participant. If time permits, you may join the queue for any follow-up. The next question is from the line of Harshit Kapadia from Elara Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity, sir, and congrats for a very good FY23 you had, beating all the estimates here. Second, a few questions from my side. And now, at the start of the call, you mentioned your developmental order share was higher as far as revenue is concerned. Is it related to what product segment within developmental orders where we have seen a higher material cost for this quarter?
We participated in a couple of contracts for the DRDO. This is unlike our product, which we normally quote, there are a lot of competitive bids. We call it a competitive bid. Again, these development bids, development contracts, hoping that we'll get additional contracts. This is on a radar level. And those had a more material cost than the overall selling price. That is the last quarter. That is what you're asking. I didn't really understand your question. If that is a question, this is a couple of radar subsystems which we developed. So that is the one maybe you are replacing to. Last year order book, there are again development contracts. We last development contracts, more than 300 crores, we from DRDO on competitive bids. So these are 2 areas where we have bid in competitive bids.
Fair enough, sir. And
I just answer the question.
Yeah, sir. So you had recently launched a checkout missile system for BrahMos. Would you be able to share, this is an additional product which you have developed. So what would be the size in the overall BrahMos, missiles for if you get an order? What will be the enhanced value for you if you can share something? And is it used for all the 3 armed forces, or is it only for Air Force and Army who will be getting use the orders, and Navy is not part of the profile? Can share some insight on that.
The checkout equipment is used for all services, Navy, Army, and Air Force. We developed it way back, more than a decade back. So we cannot remember the exact date. Only the product is developed. And subsequent to that, Army, Navy, and Air Force have been buying this, along with further contingency missiles. When they buy more missiles, they also have depot-level test systems. We also buy that. Back to back, we get the contract. So we got some contracts executing this year. This year also some of them executed. We're expecting more such contracts for a naval order, which is within 5 days on BrahMos. So back to back, we should get some contracts in this.
And any size?
These are programs and these are projects, so it varies with the project size whenever it comes. So it all adds to 30, 40, 50 crores kind of business. Once in a few years we get.
Okay.
Yeah.
And lastly, related to BrahMos, you were developing a seeker for the BrahMos missiles, and I think it was under final testing. Any update on that? Have we received that clearances, or we are still in the testing mode? That would be helpful.
We have done some air trials. Now the missile trial is supposed to be done probably in another 2-3 months. Once we finish it, we will tell you.
Fair enough, sir. And all the best for the future, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Vignesh Iyer from Sequent Investments. Please go ahead.
Congratulations, sir, on a strong performance for the year FY23. I just want to understand, usually quarter 4 for us is a very strong quarter in terms of revenue booking, and with that comes the operating leverage kicking in for the company, and that has been consistent for the last 2 quarter 4, as in 21 and 22. So I just want to understand, on the margin profile side, why have we seen a lower margin, compared to earlier Q4, and mainly because of like employee benefits and other expenses. Just I want to understand, is there any one-off on the expense side for this quarter?
The first part, let me answer. Second part, maybe Venkat can answer. Traditionally, this company has been in developing mode with DRDO and Department of Space. And, we develop the product for the year and try to deliver before March, because there is also March fund release, etc. from the customer side. So almost all the products are developed, and we find, we take 8 years back, 10 years back and all that, we find that very high 80-85% will be in the last quarter. That is how the revenue was. And we've been thinking about how to even out the cash flows, if is necessary, and not take it everything to last quarter. And as we went public, this is one of the very important things we set ourselves, because before going to IPO, we started getting visibility on year and a few year visibility. And then we want to scale the business. So one important aspect is to even out the cash flows, ensure that last quarter is not really the major quarter. No, it will be still higher. It should not be so high as 70% and 60%. So we have successfully brought the quarter-on-quarter, moderated the quarters brought the quarter last quarter from 70% to 46%, 49%. And this year also, we expect to bring the last quarter turnover to below that, so that the cash flow gets evened out. So this is the right thing to do, and we're doing this in a very difficult government business. We're trying to see how do we make the quarter's performance better. The next part on the margin profile, I don't know what, I couldn't understand the question. Venkat, did you understand? Can you answer this question?
Yeah. Hi, Vignesh. Actually, Q4, we've had some specifics because we've announced salary increment for all our employees effective from November of 2022. Plus, towards year end, when we do an actuarial valuation for gratuity and leave encashment provisioning and other things, because last year we had a lesser attrition will lead to higher provisioning for gratuity and other things. So these things have contributed some substantial increase in our employee costs quarter-on-quarter basis. This is the main reason for reduction in Q4 margin. But of course, on the gross margin level also for Q4, it's a couple of contracts where the material cost was higher than our normal material cost level. The gross margin was less, and additionally the employee cost has contributed to the reduction in the EBITDA margin.
Thank you. Mr. Iyer, request you to join the queue for any follow-ups. Also, ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your question to one per participant. If time permits, you may join the queue for any follow-up. Thank you. The next question is from the line of Ravi Naredi from Naredi Investments. Please go ahead.
Thank you very much to give me opportunity. Sir, you mentioned large order value tenders with the Ministry of Defence under first and second category. Can you tell what is the value of tenders?
So that varies a few hundred crores to a few thousand crores. And make one, of course, value will be lesser. Initially start with the value of the contracts will be lesser, but we will get into a large requirement as we go now. Once we do a make one or a make two, the development contract size may be 20, 30 crores, 100 crores, or 200 crores. But the requirement, why this is done as make one, make two, is because the requirement is very large. And it is best that we do it in India. So design contracts start with, this is called MODs, design contracts. These are not contracts which is like a buy, more a development contracts. That is what the make one, make two has. So entering into this contract is successful, then it gives you a hold on very large contracts as you go along.
Thank you. The next question is from Garvit Goyal from Invest Research. Please go ahead.
Hello. Good morning, sir. Sir, despite showing a tremendous earnings growth, our operating cash flows turned negative this time due to rising trade receivables. So my question is, at one place we have included a slide in our presentation mentioning about well-managed working capital. Then why the same is not getting reflected in our cash flows, sir? And how we look to manage our cash flows going forward, as earnings growth without cash flows is a matter of concern for sure.
Can you answer?
Yeah. See, our operating cash flow is negative because substantial, increase in the current assets this year at the end of March. At the opening remark, I have made a specific mention about reduction in our receivable days. Post-collection happened in April and May. We got substantial collections of more than 25% of March receivable in April. One contract contributed to more than 100 crore of receivable. Actually, that got delayed, and we have got substantial portion of that in April. So netting off that, if you see the operating cash flow would have been in plus only.
Going ahead, I think this is an aberration for this year because of the amendment for the contract which we wanted has taken a lot of time because the company is going from private limited to limited company, and the contract had to get amended. The amendment is taken enormous time, so the execution is happening. The contract amendment could not happen because it has to go within the amount. So that has taken a lot of time, and based on which the cash flow, the collection cycle became bad. But that is rectified now. And with this here, I don't think that should be considered. And going ahead, I think our cash flow cycle will be far, far better. And as we say in the opening remark also, we are aware of this, and any effort will be put to see that it is brought down. And the number of debtor days is substantially brought down going ahead.
Thank you. Next question is from the line of Harsh Bhatia from Bandhan MF. Please go ahead.
Yeah, thanks. Morning. Just one question from my side. So we have spoken about Arudhra and Ashwini radar opportunities overall from a 2-3 year perspective. Any particular sense on the Uttam radars for Mech 1, Mech 2, Su-30 and ANCA? Like, are we looking at that opportunity as a segment? Because from what we can understand is that you are one of the few players who can manufacture the Uttam radar. So anything you're looking at from that perspective, and what is the competitive landscape for that particular project or segment? Thanks.
Yeah, we are looking at development against Mech 1 and Mech 2 radar opportunities and EW opportunities. We are very effectively participating on that. and also on the FY20 upgrade, we would like to participate. So for all of them, we need to develop products to address actual requirements. This is the reason why we've taken the QIP to see that we address the large opportunities coming us as a product made completely designed by us, other than buy essential parts or IP from foreign vendors and integrate it in India. We would like to make the IP here. That is the reason why we took the money. And we're very, very aware of the opportunities, and we are trying to address these opportunities recently. I can't give you exact, size of business, etc. now, because we won't be able to predict the outcome. We can only try and say what is the competitive landscape and how we will be able to address the landscape with Indian products. We are doing that. I think this is the only way to go to scale the company to multifold. Unless we look at MOD opportunities and become equal to an international vendor, compete with them and build the products. That is the only way to scale this business. So that's the reason we are taking the money.
Thank you. The next question is from the line of Manan Polaria from MKP Securities. Please go ahead.
Hi, sir. Am I audible?
Yes.
Yeah. So my question was, we've seen the developmental order share of the order book go up, and we just there on the. What I want to understand is, if you're executing the developmental orders, what would be the time frame to execute them, and by what time frame would they turn production orders?
See, I can't talk about time frame. Again, this varies. The time frame of development contracts can be less than a year or can be 2 to 3 years. This kind of scale, depending on the size of contract and the complexity of the development contract. But not all the repeat time frame is not very predictable. That is why you don't predict repeat time frame when it will happen. It just gives you a potential business, but that is depending on so many other aspects of that particular contract. So we expect the next few years the repeat business will happen. But that is why we are looking at how to get the business, what products are predictable, and that is what the management is really doing today. We how to scale the growth and new revenue products. But around 1 to 3 years is the development time frame.
Thank you. Next question is from the line of Abhishek Agarwal from Naredi Investments. Please go ahead.
Good morning, sir. Thanks for giving me the opportunity. Sir, my question is, you are targeting to order of rupees 2,000 crore to 3,000 crore. Is it on track? And any big order likely in the current year? And how much order are you expecting in FY24?
I didn't get the question. You said 2,000, 3,000 crore. You want to know what is the order expected of the intake in FY24, right?
Yeah.
I think it's upwards of 700 crores. Exact number I'm not able to tell you. But we're looking at a large portion of this year's order intake will be data patterns products, and whatever we delivered earlier. So these contracts back-to-back has come to public sector. We expect a back-to-back business for all of them. So upwards of 700 crores is what I'm thinking. And as you go along, the data will be more clear as you go along in the first 2 quarters. We also participate in a number of tenders to see whether we can, the order intake can be higher than last year. We're working on it.
Thank you. The next question is from Gagan Thareja from ASK. Please go ahead.
Hello. Am I audible?
It's a bit low, sir. Can I request you to speak up a bit and come closer to the mic?
Is this better?
Yes. Please go ahead.
Yeah. Good morning. Sir, 2 questions from my side. One is on the work that you intend to do on the satellite side. I think you indicated that's a sizable addition to your opportunities going ahead. So if you could give us your view of what could be the contribution from the satellite market for your revenues and profits from a 3 to 5 year time frame. And second has the board finalized on a succession plan? And if so, what are the contours of that plan?
Okay. Yes, we are putting a lot of investment in the satellite. We have launched our own satellites. We are now nano satellites, fully designed by us, launched and working successfully. These satellites are built with different satellites and other satellites in mind. So we built everything redundant. So there is no single point failure. And everything, including ground stations, receivers, all the software, everything is designed, hardware has been designed by us. Quickly get ahead. We're trying to make serious class satellites of 150, 200 kg class, lower Earth orbit satellites now, including payload, both for optical imaging as well as radar imaging. We are developing products ourselves. And quickly we will be starting the design that it's being already initiated. We expect that maybe we should get some development contracts as we start the development cycle itself. We expect something to happen, but that is not to be clearly, we can't say that clearly now. But we are on the job. And these will be world-class satellites, completely meeting our defense requirements. We have all the specifications that we require. We are trying to meet all of those specifications in our design. So once this is developed, not only India, where multiple numbers of these satellites are required for surveillance purposes, but these are required across the world. So as we're building world-class satellites, we expect that once few satellites are launched in India, the same can be available outside. So we would one of the products we want to help the data pattern scale. This will be one of those products. But exactly size of revenue and business at this present point, I'm not able to tell you. But what we can tell you is the size is very large, and India has a competency model, and we can get ourselves has all the knowledge to build this. And we worked on 8 years on development of satellites in all parts of it. We're trying to see what we can do to all the satellites. See, then we look at the business model. But in the meantime, we'll start marketing this product also. As for a board succession plan, yes, that is on the cards, and that has been discussed in every board meeting. We also, last year, Vijay has been inducted into the board. He is the CEO of the company, and he has just more than 20 odd years. We've inducted him to the board, so that we can also understand board operation in the company. Also, we are trying to build a top management structure. We're trying to recruit people outside. There's a lot of activity to see that organization build is happening. And the board and all of us are working on that to see how we can strengthen the organization moving ahead. Because the opportunities in front of us is very, very, very huge. So we are understanding seizing the opportunities in what we can do. Right. Both the people and the position, yeah.
If I'm permitted, I have one more question. Can I go ahead?
Yes, please. Go ahead.
Yeah. Sir, I think over a period of time, you indicate that, the share of integrated projects will inevitably rise as you intend to go after larger scale projects. That being the case, what should one think of as sustainable in terms of margins and working capital for you? If one sort of presumes that that is the direction in which the quality of revenue.
Okay, see, just because we say we are scaling, it doesn't have to necessarily come out of integrated projects. Okay, we can build the radars, and the radar can go into aircrafts, and the aircraft radars can be 20, 30 radars every year. If we are doing that now, that also can scale. Similarly, RWS can scale. The avionics, APRs can scale. The quantities can come from the same avionics or electronic systems we design. That is also scale. The satellite market can scale where the bought out may not be as large. Some are bought out there. But those two necessarily scaling does not mean it has to be only integrated programs. What I did mention is, in the event of integration products come into the picture, there is the margins, obviously gross margin will be lesser. So that is what we mentioned. But it's not that scaling will happen only with integrated projects. I don't think that is necessarily true. Yes, in certain MOD tenders, when trucks are bought together to integrate, you need to buy the trucks, the EPS, the generator, and a lot of other systems which is a bottom. So we need to take this together. But it's very difficult to predict what will the margin be in this contract and estimate the revenue for 3 years from now will be this, unless the contracts are already on hand. They're only bidding for the contracts, they're already engaged in these contracts. So we won't be able to give you an exact number on the margin profile. What is important is what I said in the opening remark. With respect to the margin, what we are worried about is the bottom line growth, the PAT growth. We are confident that we will scale PAT more than 30% year on year in the coming years to come. And we look at contracts to help us to see whether the PAT margin will maintain and will scale. Once we do this, answer the second question was working capital. And the PAT margins are this large. I'm sure we will organize the working capital. And there is also an element of advance which the customer gives in all these contracts. So through non-fund limits, we should be able to actually carry out the working capital. The problem is what we see as we go along now. I don't see any problem in the foreseeable future of working capital issues for the company. We're also generating a lot of cash. So we will be able to handle that without a problem. I can answer this question more once the contracts come in at a particular time. Then we will be able to answer this question properly.
Is semiconductor chip availability a bit of an issue? Because I think some of your peers in the public sector have pointed out that it's constrained their ability to execute on schedule, specifically in the missile projects.
We had a problem last 1.5 to 2 years. It's not a problem because predictability of the component. We place the order after 7 months or 6 months or 4 months. The component is supposed to hit our stock. And at the last moment, it will get postponed. We had issues like this. To compensate and address the market, only what we've done 2 things is order ahead because of the panic in the market. So our stock holding has gone up because of this particular phenomenon. We see that our stock holding has substantially gone up in the last 1 year. To see that we hold stock and deliver and not give a problem on non-delivery. So we've handled that possibly. Second thing we got is some of the components in power supplies where their predictable delivery model was not there. We redesigned those portions. Yes, there was a shift in delivery and we compensated the quarterly revenue with some other products which we could deliver at that time to manage the quarterly revenue. But we've come across all of those problems. Today, I think we have a fairly good hold on the component. At the present moment, we don't have great challenges which we have faced 1.5 years back. So I think it's tapering down. But we're taking other decisions to stock and sell and also redesign. We're doing it. We don't have this. The problem is not so imminent or looking large now.
Thank you. Mr. Pareja, I request you to join the queue for any follow-up. Also, before we take the next question, I'd like to remind our participant to limit their question to 1 per participant, please. The next question is from the line of Vivek Gautam from GS Investments. Please go ahead.
Yes, sir. Sir, my question is more on the sector side. Is the change in Ministry of Defense and DRDO for real? Because EMD used to change every 2 years earlier and the work culture was somehow lacking due to the job security and time-bound promotion and other things. And any political risk also, sir, in this election year, and what steps are we taking to negate the risk in case of a change in the regime of Modi government? Thank you.
Your voice is very... I couldn't hear it properly.
Hello? Is it better?
Make a short question. I couldn't... Yeah, better.
I just wanted to know, sir, is the change in Defense Ministry of Defense DRDO for real? Because earlier, like the typical PSU, the CMD used to change every 2 years, and then the job securities of the employees and time-bound promotion. And second thing was about the political risk in the election year. If the regime changes, what steps are we taking to be prepared for it in case?
Okay. DRDO, MOD changes are not very particular. They were not recruiting people in the last few years. That has been opened up in DRDO, so they started recruitment. But I can't comment on that. But looking at a risk profile, we are looking at what is the risk. We are addressing the risk profile internally with those strategies. The second major point we talked about is the change in political scenario. In case a change regime happens, what really happens, our will affected. I think, whatever direction this government has put India in defense on making India kind of program, this can't be changed even if there's going to be a change. Because what has been done, right, the dependency on funds is very, very high. Public involved policy cannot be changed overnight. So it is going to take a lot of time. Any change happens in government slowly. So change otherwise also will happen slowly. So we are not really unduly worried about change in regime, bringing change in business practices or opportunities in India.
Thank you. The next question is from the line of Rikesh Parekh from Rockstud Capital LLP. Please go ahead.
Yeah, thanks for the opportunity. So my question is relating to the order book. So we have a large portion from the development contract. So based on our past experience, how much percentage of the development contract converts into production? And also, are the margin any difference between the development and the production contract?
It's very difficult to predict the conversion ratio from development to production. We found in the last 15 years, we were not able to predict it very well. And it used to be ups and downs on this contracts. So we're used to this kind of roller coaster kind of ride which is being said. So what we did, we took certain strategic decisions on where we participate and what kind of contracts we participate. We are not really participating in component level, PCB level systems now, where that continuous change happens in these kind of contracts because new components come in the market 2 years down the line. They want to redesign it. So these kind of things which gives you very, very poor visibility and control over the program, we are no longer participating in it. We participate in contracts where a substantial sum of the percentage of the contract is designed in-house. This is where we bring in the competencies and the competitive advantage which we have. Since everything is designed by us, we have to integrate the systems. We bring in a value add here. We become pricing and also in terms of time frame. We can deliver far ahead because everything is designed in-house and we make the building blocks too. So this is a strategic decision we took and that is paying off properly. In this, we are taking to only develop into main contracts, which is a high probability in the production contract can happen. But still, I can only talk about high probability. From the knowing the customer, knowing the products, we try to see what we can do. And exact say when we develop a contract, what percentage will become production is something is not a very clear science as of now. Ask the second question. In the development contracts, margins are higher, in production contracts, the margin becomes lesser. That's not necessarily true. During development contracts, the gross margins, whatever we have, and we absorb the development cost. So probably we make lesser money because we try and develop the products, the manpower overhead costs, and the prototyping costs, the test costs. All these costs are all incurred during development stage. But what we do is we expense the development cost as part of the development revenue itself. So in that year itself we expense all, we don't take it to overheads. So the production cost happens when those additional costs which we incurred are not repeated. So our gross margin remains same. So unless otherwise volumes are large and different negotiations have happened and the requirements have changed. But normally the gross margin remains same. And as we compensate for the foreign exchange rate change, etc., overhead change, increase, all these also compensated and priced accordingly. It's always good to have a ratio of development and production in the business which we have.
Thank you. Ladies and gentlemen, due to time constraints, that would be our last question for today. I would now like to hand the conference over to Mr. Rangarajan for closing remarks. Thank you, and over to you, sir.
Okay, thank you very much for participating in this call. I can only say that we are very excited about the future. The size of business is exceedingly large. We have built a company with a whole lot of product competencies and capabilities, a very high share of engineering graduates in our company. We expect to build IP and competencies going ahead. We have taken 5 crores of QIP money to see that we build products which can scale the company multi-fold as we're going ahead. We have a sizable order book. We have a sizable visibility of orders going ahead from here. So I think we are on the right path, and we can build a substantial kind of business here. The opportunity is very huge. And Made in India is there to stay. And unlike others who are trying to build and collaborate in making India, we're trying to address the opportunities by making products in India, which will give us a better bottom line, better EBITDA, and much better scalability going ahead. So any further questions you also write to us, and we will answer those questions with Go India. So we'll be able to answer all the questions. Thank you for taking this very much.
Thank you very much. Ladies and gentlemen, on behalf of Go India Advisors, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines. Thank you.
Thank you.